And that's where they got in trouble. They basically commingled customer funds with their hedge fund. Yeah, so I do think there is some contagion risk here. I think there's other firms that had, first of all, there's firms that had money just sitting in FTX, and that's now going through bankruptcy court. So that's been bad.
Brian Armstrong is the founder of America's largest crypto exchange, CoinBase. In this highlight, Armstrong unravels the chaos behind the collapse of FTX, explaining what they did wrong and what will happen to the lost funds in the future. Also, Armstrong reveals what features to look for in a safe, trusted crypto exchange and why his company, Coinbase, will never face the same fate as FTX.
So if you're a regulated financial service business, but you're not a bank, we're regulated as a trust company, a money transmitter, et cetera. You're required to hold customer assets one for one, denominated in the asset. So in other words, if you say the customer has one Bitcoin, you have to hold one Bitcoin. If they say they have $100, you have to hold $100. And so that's the case with Coinbase. You don't have to take our word for it, by the way. You can look at our audited public financial statements as a public company with an independent, Big Four accounting firm who went to go verify all of that. And that's what various custodians and exchanges, that's what they all should be doing. By the way, if you're regulated as a bank, you can actually go invest some of those, but there's very strict regulation around that and capital requirements and whatnot. And we're not a bank. So we hold one-to-one. Now, if you're an investment fund or a hedge fund or something like that, then you can try to take positions in different coins and different assets, and they could go up and they could go down. You may lose your investors' money, but there's no such thing as the customer assets being involved in that. There needs to be clear segregation of those customer funds and from what an investment fund would be or corporate funds. And that's where they got in trouble. They basically commingled customer funds with their hedge fund.
Classic fraud.
Yeah. Can you explain the contagion, by the way, just so we can, because everyone's been talking about the contagion and understanding what's next. So that's what I just want to, because I think people are going to be asking that a lot this weekend.
Yeah. So I do think there is some contagion risk here. I think there's other firms that had, first of all, there's firms that had money just sitting in FTX, and that's now going through bankruptcy court. So that's been bad. I mean, Multicoin came out publicly and said that they had 10% of their portfolio sorted on FTX. There's other firms that Alameda may have had loans with, and those firms are probably struggling. I don't want to say who, but we have received a couple of inbound calls from other people trying to get emergency financing. There's people who may have just totally different from FTX and Alameda. They may have just had their own portfolio that they took margin or leverage on to buy crypto. And now as the prices have come down a little bit, they're getting stopped out. So that's all been very challenging. And I again, just for the sake of clarity, I should say that Coinbase did not have any material exposure to Alameda FTX or FTT token.
Can we just talk about this issue of customer deposits? Because this is really the crux of the issue from a legal standpoint, right? I mean, I remember when I was doing PayPal like 22 years ago, and the company was like 6 months away from running out of money. I remember the lawyers told us really clearly, you cannot use customer deposits to fund the operating expenses of your business. In other words, if this business ends up going bankrupt, you'll still have all the customer money there and they'll be able to get it back. And, it was really clear, like, hey, if you use customer funds to pay for the burn of the business, to operate the business, that is a do not pass go directly to jail type offense. And so like, that's really the heart of this. Now, I read in some articles covering this that the way it worked is that Alameda had a bunch of these FTT or these FTX tokens called FTT. And they basically use that as like a marker, as collateral. So that they basically borrowed, like 6 billion of customer funds from FTX. And then they used their own token to then as collateral. So
to backstop it.
Yeah, exactly. And then what happened is apparently like CZ got wind of this and he owned a whole bunch of these tokens and he signaled that he was going to dump it. And the price basically went down. And so now all of a sudden the collateral for the customer loans was insufficient. And then there was a run on the bank. And
by the way, this happens in the public markets a lot as well. So like when you see heavily shorted names or when you know that certain hedge funds are on the brink, other hedge funds will go in and essentially force a margin call and a stop out, because then it's what causes all of these runs. And if you look actually inside of GameStop, the reason why you got all this gamification in the GameStop equity and a bunch of these other names was in part because of this dynamic. Folks that are highly levered, folks that don't have the right matching of risk. And what happens is they're solvent but illiquid. And then if you run the instrument into the ground, they both become insolvent and illiquid all at the same time.
Look, I don't know who inside FTX's and its orbit of companies actually knew that the fraud had been taking place. It would not surprise me. I have no idea, to be honest, but it would not surprise me if FTX US people and employees had no idea that this was happening. I'm imagining if Sam was doing, when he started doing this, he probably wanted to keep it to a very small group. Otherwise, this is the kind of thing that leaks and the whole thing blows up. Now, that being said, I don't necessarily think FTX US is worth anything as a business right now because of the brand being so tainted. And there probably was not great separation of these entities in the sense of, like, did they have truly separate boards and beneficial owners and governance? And Sam seems to have, it appears that FTX didn't really have a CFO or maybe even like a real board or anything like that. And so it's hard for me to imagine.
We found on Reddit, there was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker site called Ultimate Bet, which in the 2010s did this exact thing, apparently. Some version of this where they went in and they looked at hole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the hole cards were, ran this cheat, stole millions of dollars. Somehow that person found a way to be head of compliance at FTX 10 years later. Which is incredible. But back to this question. So now what happens now is you have the international business and the US business and Alameda Research all rolled up into this one frozen entity, right? With now regulators having to. So do you know what happens in a process like this? Like, is it that the DOJ and the SEC get priority, or is there some international monetary, like who unwinds all of this? How do people get their money back, if at all?
Yeah. So I'm not an expert at this, but my high level understanding is that the bankruptcy courts will essentially, and I believe they filed bankruptcy in the US, which is an interesting thing. I didn't know why they did that versus Bahamas. But anyway, the bankruptcy court will basically go through and try to find any assets of value. So, I mean, they still have some tokens and value. They have a venture portfolio. I think Sam owned 9% of Robinhood. There's various things that they may own. And then they'll kind of auction those off to various bidders on distressed assets and then try to distribute those funds to the customers. I don't know the exact process beyond that, though.
I mean, if you remember, the Madoff wind down took many years. And for years, he was trying to find assets. And then he found a market, sold them. There's the trustee. I think he's still active. And then, tried to redistribute the funds. Obviously, so many more customers here than there was with Madoff, but it can be a very long and winding process to identify all the assets, then run the market sale process on them, then figure out who gets what first, and then distribute.
There was an interesting thing that Larry Summers did, I think, for Bloomberg, where he was asked whether this was Lehman or Enron. And he said, it seems more like an Enron than it is a Lehman. And Brian, I'm just curious how you think about it. Like, is this sort of a fraud perpetuated by a group of executives to essentially take advantage of a situation? Or do you think that this is more like a Lehman situation, which is a well-run business, I guess, that just, got caught in a liquidity trap?
I think my guess is it's a little more like Enron in the sense that, I mean, yes, they were over levered and that kind of thing, but the minute that they moved customer funds in some way, shape, or form to backstop the hedge fund, that was, in my mind, fraud. And, that's more like Enron.
Do you think now that we have to open the gates on regulation, like the whole point of crypto in some ways was, trust nobody and, decentralization is the key. But here what we see is a lot of people were tricked into trusting FTX and having their deposits there. And it was a centralized exchange, which caused all these problems. So it's like, it almost violates the principles of what the whole product market fit was supposed to be. So what should sort of the observer expect? And what do you expect as a business in terms of how governments now react to all of this?
Yeah. Well, I think it's really important to distinguish between the centralized players in crypto, which are custodians, exchanges, et cetera. Coinbase has a big business there. And the decentralized players, which are, self-custodial wallets, DeFi protocols, Web3, that whole world. So the centralized players should be regulated, and today they're regulated already, like kind of traditional financial service businesses, but they don't have the regulation clear when it comes to the crypto aspects. So, for instance, in the U.S., we actually don't still have clarity about what is a commodity, what's a security, which one should CFTC regulate versus SEC, that kind of thing. And that lack of regulatory clarity, and frankly, the climate of regulation by enforcement, the negative rhetoric from, Chair Gensler in particular, has created this sort of chilling effect in the US that has pushed a lot of that centralized actors' activity offshore. In fact, 95% of the trading volume in crypto is now outside the United States, and it's come down a lot since the beginning of this year even. Now, the decentralized players, self-custodial wallets, DeFi, Web3, this is where crypto really has an opportunity to make a more fair and free and transparent system, because You can go look at any smart contract to see exactly what it's doing. Anybody can audit the code. If you have a self-custodial wallet, you can just trust yourself. You don't have to trust any other intermediary out there. And that's where you get true decentralization. And I think that's actually, now, those areas still have a couple of their own challenges. Sometimes people will lose their password or their phone and they'll lose their own money. So if you're trusting yourself, you still have to trust, that you're going to do that piece correctly. But there's a lot of good things we can do there around making social recovery mechanisms and MPC wallets and things like that.
Are you a long-term investor? Then I'd highly recommend you watch this video where Carl Icahn explains what exactly to look for before making an investment in today's market.